What is going on, everyone? Hope y'all are doing well, and in this video I'm going to share Opendoor's earnings report and conference call. I just talked about this company a few days ago, and with several people asking me to make another video, I decided that it was a good idea to share not only what I thought about the company's earnings, but also the market as a whole. But I don't want to waste your time, so with all that said, let's go ahead and dive right in. So the first thing that I think is important to note is the amount of homes sold has fallen a lot. So the Opendoor transactions are lower than last quarter and will probably continue for the rest of the year. But even with transactions lower, the quarter was not bad at all. Plus, even though the slowdown in transaction volumes was faster than they anticipated, it is still in line with the 2018 and 2019 environment. Homes are just selling slower than what we saw in the previous 2 quarters. Now, I will talk about their guidance because they were not great. But when we look at this quarter's numbers, I was quite impressed. So in Q1, they reported a 35% conversion rate for 2021. And even though we didn't get official conversion rate numbers, they said that they are seeing conversion exceed their expectations at their current spreads. So even with interest rates going up, they're still seeing relatively similar conversion rates. Along with the conversion rate, another thing I want to pay attention to is their sell-through rate and the amount of time that listings have been on the market. Now, when we look at Q3, which is the quarter we are currently in, they're going to reduce their prices to keep up with the market shift. Now, they didn't specify about the number of days on the market like they mentioned in May, but I think what is important is that they are expecting less buyers in the entire market. This is not Opendoor's fault, so that is important to note. However, they will be affected by this market shift. Now, Robert Zeller of Truist asked a really good question. He said, does the lowering of mortgage rates provide a catalyst for homebuyer demand in the back half of the year going into 2023? Now, Opendoor didn't really answer the question, and I think part of that is because of how quickly the market dynamics changed in the past quarter, but I do think that this is an important thought to consider. Especially if we go into a time where consumer spending reduces and unemployment kicks up, the Fed will not have a choice but to reduce rates, especially if inflation falls, and that leads to a good time to buy for home buyers. But despite the recent market shift, Opendoor had a really good quarter. When we look at their revenues, they were smack dab in the middle of their expectations with $4.2 billion. And yeah, that was good. But what I loved about this earnings report is their adjusted EBITDA. They completely blew this number out of the water with adjusted EBITDA reaching $218 million. And they were expected to have between $170 million and $190 million. This goes to show that even though their revenues were lower than Q1, they were still able to have better earnings, which provides evidence for Opendoor to become a consistently profitable company. Another thing that I was really impressed with this past quarter is their expansion into new markets for Q2. They added 6 new markets and are now in 51 markets total. The 6 new markets include New York and New Jersey, Detroit, Southwest Florida, Boston, Albuquerque, and Cincinnati. What I love about these markets is that there's a lot of diversification of cash flowing and appreciating markets. So with all these newly added markets, they are now expanding their underwriting capabilities to cover nearly 30% of US home transactions. Now, one of the things I was wondering about in the previous video is that given the dynamic market environment, would Opendoor's approach be more focused on growth or margin? And I think they really brought that answer to light during the Q&A. They will be focusing on the existing footprint first. And so even though they're opening new markets, it will not be at the pace we have seen previously. But not only are they expanding their possible transactions, they are also expanding the amount of traffic by their new partnership with Zillow. This multi-year partnership gives their hundreds of millions of monthly visitors the ability to instantly request an Opendoor offer and sell their home online. This will save a lot of money on marketing. They're expecting this partnership to go live in the next coming months. Their goal is for every homeowner in the country that is thinking about moving to have an Opendoor offer available. And with Zillow having over 200 million monthly visitors, this is a huge step in the right direction. Considering what we've seen from Zillow entering this space and then leaving it because they got destroyed by buying overvalued homes to now partnering with Opendoor, it looks like they're giving Opendoor the opportunity to be the leader in this space. And I believe that this will be an amazing chance when it comes to branding for the company. Now, Opendoor has decided to not focus as much on acquiring homes as they will make sure that margins are being met. However, what I'm seeing in the current market is that many sellers are making price cuts in a short amount of time, like within a week or so. This market has people fearful of not being able to sell their homes at a profit, so they have continued to make price cuts. And so even though this may not help Opendoor's margins when they go to sell their homes, this could create a tremendous buying opportunity here in the near future as markets begin to stabilize. But the issue is that the amount of time that homes are on the market is still much lower than the average. In the previous conference call, the team at Opendoor expected that the housing industry would begin experiencing a moderation in home price appreciation and transaction volumes beyond normal seasonal trends in the beginning of the second half of this year. But they did not expect to see this quick of a change in pace. Now, normally that home price appreciation peaks in Q2, which is what we saw. But because of the drastic changes in the home environment, the home price appreciation will be lower than normal. I think this is a big reason why Opendoor did not give strong guidance for the rest of the year. When we look at revenues, the company is projected to have between 2.2 billion and 2.6 billion for this upcoming quarter. Now, this is definitely a broad range, but I do think that they are underestimating themselves because of how quickly the market shifted from their favor. Now, do I expect a huge beat from their expectations? No. However, I do think that they could be on the higher end of revenue. But what was not pretty from their projections is their adjusted EBITDA. They're projecting between negative $175 million and negative $125 million. Now, compared to these past couple of quarters, it's not good at all. But I honestly believe that this will only be temporary as they get rid of their current inventory. The reason for this drastic reduction is because their revenue guidance is cut in half from Q2, there are price reductions on their current inventory, and they will have lower margins on new acquisitions. The reason for the lower margins on new houses that they acquire is because new homes will not be as available on the market, and older homes tend to have lower margins. Even if a few of these markets that they hold homes have drops in prices, there are other markets that could be appreciating at the same time to reduce any losses that occur from holding the property. However, because Opendoor only holds houses on average for 3 to 4 months, they are less likely to be affected by price drops. Now, we may see growth in the amount of times that they hold these homes, but I don't think it's going to be drastic. And speaking of reducing losses, one of their key focuses for the next couple of quarters is operating expenses. One of their primary pieces of reduction is on their marketing. But as I said with the Zillow partnership, they are actually able to reduce their marketing because of how many people will see them on the Zillow site. Plus, their strong balance sheet of $2.5 billion in cash and $11 billion in financing capacity will help them navigate the transitional housing market. And speaking of their balance sheet, their assets compared to liabilities is really good. They have total assets of $10 billion with total liabilities of $7.8 billion. They also have $6.6 billion in inventory, and half of that is in debt. So for a company that is valued around $3 billion, this is crazy. And I don't think that the share price is a reflection of their projected growth and profitability. They are almost valued by the cash that they have on hand. So I think it is only a matter of time after the market stabilizes that we will see strong price growth from Opendoor. And even though demand has grown because of the largest quarter-over-quarter increase in mortgage rates in 40 years, Opendoor says that the supply-demand dynamics will likely return to a more balanced state versus a sharp correction given today's structurally lower supply. We are now returning to a more normalized market, and this is going to be extremely telling of how Opendoor will be able to do in a regular housing environment. But as I said in the previous video, in 2002, the 30-year mortgage rates averaged 6.4%, and yet the number of transactions for single-family homes was 5 million. Even in a high interest rate environment, there were still a good amount of transactions. So I believe that there will be an increasing demand, but buyers will still want to buy homes as rates begin to steady, leading to more of a plateau in these prices. And over the past week, we have seen a sharp decline in interest rates, so this could help with buyer demand as well. Now, I do believe that we will see price cuts in the markets that have had major appreciation over the last couple of years, but not every market will experience a drastic correction. We are actually already starting to see a decline in appreciation in several markets on the West Coast, and I wouldn't doubt seeing some depreciation in some of these markets as well. The next metric that I talked about was their contribution margins. This is really telling of how the company is going to do in a lower transaction environment like we are in right now. Now, because of the drastic shift in the housing market, these margins will be lower for Q3, and I'm assuming that this will continue for the rest of the year. But my question is, what happens when the market stabilizes and Opendoor begins to acquire fire a ton of these properties towards the lows if there is a correction. I honestly believe that the guidance is only short term, and I'm not worried about it at all. But for now, when it comes to buying properties, they will have a much wider spread. So they will buy homes for underappraised values in order to still be able to generate a profit when possible. Now, as a reminder, over the long term, they are expecting to get up to 7 to 9% total contribution margins. And I believe that the new products they are working on will definitely help them achieve these margins. And the first one that I want to quickly talk about is their Opendoor financing app, which went live in California. Now, this gives customers the ability to obtain a pre-approval in as little as 60 seconds and integrates home financing seamlessly with the rest of Opendoor services. The issue with buying homes is that there is so much work and time that goes into the process, and this will help home buyers in a massive way. Now, since opening the app in June, they are seeing a good level of engagement in the app, but with the increased interest rates, we will see how the engagement changes over time. Lastly, they are planning to launch this app in additional markets over the course of 2022. So we will get a better idea on its performance, in my opinion, when they report Q4 numbers in 2023. The last product that I want to talk about is Opendoor Exclusives, which lets home buyers buy an Opendoor home pre-market. Through this product, they have a buy now price, which prevents negotiations back and forth, as well as any uncertainty during the home buying process. They also provide appraisal match guarantee, which gives customers a lot more comfort. This is especially important given the market we just got out of, with people paying way over asking price. Lastly, these homes are only on Opendoor, which drives people to the platform. Now, why is this significant? When you consider the branding that they are receiving from Zillow, more people will want to see what other homes Opendoor has on their platforms that aren't on the MLS yet. But as I said in the previous video, in every other recession besides the great financial crisis, one of the best performing assets was real estate. So housing does not look like a place where we will see devastating price drops. And so this appears to be only a temporary setback for profitability. However, with Opendoor holding homes for a short amount of time, they will be just fine in my opinion, especially in 2023 as markets begin to stabilize and we see interest rates settle as long as inflation doesn't remain high. So is now a good time to buy houses given the transition into more of a buyer's market? Eric Wu, the CEO, says that they are managing growth in their inventory with the right spreads to ensure that they hit their contribution margin targets while also managing risk. And what I'm seeing is that sellers are starting to get nervous, and because sellers have become more fearful, this leads to an increase in price cuts, and that leads to a good buying opportunity. I'm seeing some great deals in the market, which is why I'll be looking to buy another property in the back half of this year because of the power that buyers now have. And when it comes to buying the actual company, I'm perfectly fine adding more to my position. Even though there has been a massive increase in the share price, when I look at this company 5 years from now, I don't see the share price being anywhere near where it is right now. And so I will continue to buy if it is under $8. But I hope you all enjoyed this video, and if you did, smash that like button. That helps more people see this kind of content as well. Also, don't forget to sign up with Moomoo, where you can get up to 7 to 10 free stocks depending on how much you deposit to the platform. And if you are new here, hit that subscribe button and notification bell. That way you are notified when new content comes out. Hope you all enjoy the rest of your week, and I'll see you in the next one.